Spring is here, and this is our monthly housing market report for April 2023. With spring comes the seasonal shift in the housing market, right? More shoppers are out there looking for homes. So we're glad to be your eyes and ears to the latest happenings in the housing market. Let's get right into it. We're in what's called a demand-based rate environment. We update this graphic weekly. You can see it on some of our social media. Essentially, the lower the rate, the increase in buyer demand, and conversely, when the rate is up, demand dampens. The dividing line between red and green is at 6.5%. Recently, there have been several significant things happening in the economy, and we sit below 6.5%, meaning we're in a good demand environment. Sam Cater from Freddie Mac gave us a great perspective on this. He said, this turbulence in the financial markets is putting significant downward pressure on rates, which should benefit borrowers in the short term. Now, we can't be experts on, say, the secondary market and everything that's happening in banking, but we can say that turbulence in those markets is putting significant downward pressure on mortgage rates. As rates come down, it makes homes more affordable. And the three things that drive home affordability are prices, interest rates, and wages. Now, let's break down prices real quick. Midway through 2022 and throughout the fall, the national headlines scared a majority of folks in the market. Headlines like U.S. home prices could plunge 20%, says the Dallas Fed. Fortune came out and said there are 210 housing markets at risk of losing 15 or 20% in home prices. Other articles talked about homes could lose a massive amount of value are out there. One thing we stress is that real estate is local. We certainly pay attention to the national trends, but we know that California is practically its own economy, and we can say that the Inland Empire is its own economy within California. Here's the reality. Here's Case-Shiller's home price appreciation year-over-year look in the top 20 cities. Now, the reason this is important is because you see a lot of green in the top 20 cities. You see some red in there in the West Coast, Portland, San Diego, San Fran, and Seattle. But the national number there, you see it in the upper right-hand corner of appreciation over the last year is 3.8%. Why is this important? Right? It's important because it's nowhere near what those headlines in the fall said. Nowhere near that 20% depreciation. Now, some markets did see some dips, some depreciation, but it's not the trend nationally. Certainly, it's not the national average, and it's certainly not the case in the Inland Empire. Selma Hepp from CoreLogic said this. Declines in the West are due to the tech industry slowdown and a severe lack of affordability after several decades of undersupply. Right? If we continue this look at year-over-year prices from HFA, we see the same story. The Pacific region sort of flat. Every other region there, January over January, appreciating, right? The national rate of appreciation of 5.3%. So again, I'm going back to what we've been talking about. We don't see that depreciation happening, and here's proof of that year over year. If we look at the month over month, right, situation's a little bit different. This is the same look from Case-Shiller month over month in January. This information runs a few months in arrears because it's same home sales, but it's the best information you can get on pricing out there. And what do you see? The overwhelming majority? Slight month-over-month depreciation, not this runaway scenario of depreciation. So you see a few markets in the green: Atlanta, Boston, Charlotte, Chicago, Cleveland. Slight appreciation, the others slight depreciation. So that's month over month. In the IE, you'll see slight month-over-month depreciation from the high in April. But if you look at the year-over-year, December 2021 to December 2022, there's still appreciation in the IE of about 2.5%. If we look at the same with FHFA, we see sort of a mixed bag there as well, right? Some regions being down, some up, some are flat, but the worst of the depreciation is behind us. Look right here, this month-over-month appreciation or depreciation from FHA and Case-Shiller going all the way back to January of last year. And so what do you see? Well, we start off the year in 2022 with great appreciation, right? We all know about that. Come to about the middle of the year in July, we start to see that turn happening, and most of the depreciation peaked in the fall, right? And both for these graphics in August and September, and it's stabilized, right? It hasn't taken these massive dips going forward since the fall. So why is this important? Again, it's important to understand that prices in the country generally are not in a free fall, definitely not in a free fall in the IE, right? These headlines that were out there that homes are going to lose a massive amount of value, right? This 20%, 15%. That just did not happen. We have the official numbers. It did scare folks getting into home ownership, but hopefully this news lets folks know that they should get in. Right? And all in, this comes from Black Knight. Home prices nationally are now down 2.6% from their peak. That's only 2.6, not this 20%. Again, nowhere near it. Moody's Analytics repeat sales home price index are down 2% from their peak last July. Again, nowhere near that 20%. Freddie Mac reported this was calculated in the calculated risk blog that its national home price index is down 2.5% from its June 2022 peak. Right? Again, nowhere near what the headlines say, what the doomsayers were saying or predicting about the housing market. I think the worst of depreciation is behind us, especially in the IE, and you'll see the March numbers probably show month over month appreciation when that comes out later on. So expect a strong seller's market this spring with the downward pressure on rates. Homes become more affordable, if even slightly. That's going to get more folks into the market. And then eventually, right, that'll cause a switch and prices. Again, values are continuing to appreciate. There'll be a little bit of a bump up with the bum rush that we should expect in the spring. And so to talk about that affordability, I'd like to pass it on to Yvette.
Thanks, Robert. When we start to think about rates and prices, people have a lot of questions about affordability. The biggest one being, will we see affordability improve this year? We work with a lot of first-time home buyers, folks making the move over from renting, and because of values, buying a home could stretch someone's finances. However, a common misconception about affordability is that prices have to go way up or way down to really move the needle on affordability. And that's not truly the case. How do we measure affordability? It's a combination of prices, rates, and wages. And right now, we're in that rate-sensitive environment. I want to start with this quote from Realtor.com, and it says, "Each downward tick in mortgage rates is met with increased buyer demand, as many eager home shoppers take advantage of the slightly lower cost of financing a home." Depending on your credit score, you can get a rate under 6% today. As we've seen a bit of that easing in mortgage rates over the past few months, it costs less to finance a home. So we're seeing affordability improve, if ever so slightly. So let's take a look at that. This is home ownership affordability, and it walks through the year-over-year declines that we've seen since January 2021 to January 2023. As you see, no surprise, it was more affordable to buy a home in January of 21 before mortgage rates ticked up significantly. Look at those really dark red bars. Affordability dropped by nearly 30% in that period of time. But what do we see right now? We see that moving in the right direction. Those lighter red bars over on the red coming back up, showing that affordability is improving. That is largely due to this rate-sensitive environment when we see mortgage rates easing off their peak. Now let's take a look at affordability in a longer-term context. This graph shows that affordability right now is at historic lows. In the Inland Empire, once affordable cities are seeing population rise, as well as infrastructure improvements and growing commercial corridors. And so it's only a matter of time before they're no longer affordable as well. When we look at this graph, we look for how high is the bar. The higher the bar, the more affordable it is to purchase a home. Now, those orange bars are when the housing market crashed. So that's when distressed properties, foreclosures, short sales dominated the market. That's when prices brought affordability to a much affordable level. But we're in a different environment right now. And when we look at those lines over to the right, we can see that affordability is much, much lower as we've seen the volatility and mortgage rates over the past year. This is the same housing affordability index, but it zooms in on a month-over-month basis. See January of 2021. No surprise, the bar is higher. It was more affordable to buy a home before rates more than doubled last year. We saw that affordability decline throughout the year, and now we see it moving in the right direction. We see it ticking back up. And the way that we break down this index, put together by NAR, is we look at that dotted line across the screen. That's the threshold on the index, and it measures a score of 100. 100 means that the home buyer making the median price income can afford to purchase the median priced home. the bar is above that threshold, homes are more affordable. If it's down below, then qualifying is more challenging and being able to afford a home is much, much more challenging. We've seen above and below that line over the past year, and we see it starting to tick back up. At January of 2023, that's the latest data we have on this. And that's when mortgage rates were in that 6.5% range. We saw them ease off their peak. Well, the good news is we're starting, even over the past couple weeks, seeing mortgage rates ease back into those levels. That's largely due to the financial turbulence that we've seen in the market. So rate-sensitive environment truly impacting affordability right now. When we talk about home affordability, it's not just the value, but the monthly mortgage payments. So let me break down this data for you as well. At the end of the day, someone who's purchasing a home needs to be able to make their monthly payment. That was much easier to do in January of 2021 when it was much more affordable to buy a home. We saw that creep up very significantly over the past couple of years, and the monthly mortgage payment, the median monthly mortgage payment, it peaked around October of last year. We saw much higher mortgage rates at that point. Well, now that we're seeing mortgage rates easing, that monthly mortgage payment is coming back down. We're easing off that peak. So that's about $200 difference since last October. If someone didn't qualify for a mortgage or couldn't afford that median monthly payment back last fall, maybe they can now. So let's talk about the next layer, which is median household income versus qualifying income. I love this graph because it really starts to show how this is so hyper-local. We know that mortgage rates and wages are our primary driver, but we also know that prices are doing very different things in different markets. And so when we are talking about affording a home, this becomes really powerful. So what we're looking at here is the blue bars show median income in each region of the country. We have the US total average over on the far left. And now the other bars, the green and the orange and the red, that's qualifying income for a median priced home. So what pops out at you as you look at this? Immediately, my eyes go to that red bar over on the right. It is much more expensive to purchase a home on the West Coast than it is in some of the other markets. So a median priced home, people on the West Coast on average, not making the income that it takes to qualify for a median priced mortgage. That's really challenging in some of those markets, as we've seen prices accelerate more in some markets than in others. This has been a bigger pain point in different regions of the country. So now if you look at places like the Midwest and the South, it's the opposite. So those making the median price income should be able to qualify for a mortgage on the median priced home. Let's talk about the Inland Empire. Nearly every big city in the IE is undergoing infrastructure improvement projects, have strong housing plans in place that cover at least the next decade, and have some great commercial projects underway that improve the desirability of those cities. There's a living wage push, certainly in the construction industry, and many factors at play. If you're a first-time home buyer, congratulations. Now is the right time, especially in the Inland Empire. We expect values to increase, but if wages and rates behave accordingly, the IE remains affordable. Real estate is local, regardless of what you hear in the news. So now let's take a look at one more piece, and this is the mortgage payment to income ratio, and it goes all the way back to 2000. This is put together by NAR, and the recommendation is that when someone purchases a home, that they spend no more than 25% of their income on principal and interest. For lower income earners, that means the harsh reality is that they are spending more than a third of income towards their housing, sometimes 50% or more if they rent. We'll highlight the 25% threshold. Now, what do we notice as we look at this? For a long period of time, we were under that 25% threshold. Homes are more affordable, and people could spend less than 25% of their income to purchase the median price home. Well, what do we know from last fall? We ticked up above that threshold. However, we see this moving in the right direction. We've come down off that peak, underneath the threshold. And again, we're not out of the woods. It is still challenging and not as affordable to buy a home as it was a couple years ago, but we are moving in the right direction. So as we wrap up today, I want to finish with one question for you. What is the one thing that could stand in the way of purchasing a home this spring or summer? After working with several first-time home buyers the past couple of months, I'd say mindset is the biggest challenge. Beyond the credit score or income, if you're in the IE, do not sit on the sidelines. We advise homeowners, not investors. As a home buyer, the sooner you get in, the better off you'll be. And the state has a lot of programs for first-time home buyers. We just got a first-time home buyer with good credit into a $500,000 home with zero down and no PMI. Months ago, he thought he couldn't do it, and now he's a homeowner. There's so many challenges in this market right now that we can't control. However, what we can control is our mindset. Make it your mission to get into a home, and it will be. If we can help in any way, even a complimentary consultation, connect with us via email, text, or call. I'm Yvette Romero.
I'm Robert Carrillo.
We are Carrillo Group CNY, where we do real
Real
estate
estate
with
with
purpose.
purpose. Peace.